G'day expats, welcome to another episode of Expat Chat. Today, episode 24, and I'm joined here with my colleague and friend, Brett Evans. How you going, Brett?
Mate, well, thanks. All good in the hood in the sandpit. And today, for folks at home who are listening and can't see the little words down below, I'm joined by my good friend and colleague James Ridley, who's the managing director for the APAC region. How's things back in Oz?
They're good, Brett. We're quite lucky as usual with the weather. The vaccine program, it's all starting. It's been rolling out now, and I think they even mentioned that they've got double the amount of GP clinics which have come forward saying, "Yep, listen, we're happy to administer it." Obviously, it's all free, so it's good to see that things are moving on that end. I suppose at the moment we've just got the Pfizer and AstraZeneca, I suppose vaccinations, but we'll see if we get some more. I know you've got some pretty unique ones over there.
Yeah, we've got we call them the different flavors. So you've got the Chinese flavor, you've got the English flavor, and the American flavor. So whether you want ribs, whether you want pork crackling, or whether you want fried rice, we can do them all here. So.
Yeah, that's right. And I suppose as a bit of a high-level summary of today, we're going to talk about some myth busting. We've got some great Q&As to go through that have been sent in. We've also got a really important update, something that's been running for a few years now under Atlas Wealth, and I'll hand it over to Brett in terms of its fourth year running now. But Brett, what is that?
Before we go there, let's do get the jingle out of the way. That all information that you'll have the privilege and pleasure of listening and watching today is for educational purposes only and should not be construed as personal advice.
Absolutely, all for entertainment purposes.
Exactly, because people are sitting at home with nothing to do, of course.
That's right, God. But I mean, listen, we're pretty excited to announce another year in the running, and something which a lot of expats use. Some use them even to decide whether they're heading over to countries, to be honest, and whether to become an expat. So what is it in its fourth year running?
Yep, so this will be the fourth year of the Expat Insights Survey, and it's a survey we've been running with Australian expats around the world. And in the past, pre-COVID, it was a useful tool for people to get a barometer of what the coalface feedback was like for an Australian expat in that particular city or country. And there's a lot of expat surveys out there, but this is the largest one for any purely Australian expats. And we often find that Australian expats have a different way of viewing things, living, circumstances and those sort of things. So the feedback we've received in the past years has been people love it because it's an Aussie giving an Aussie's interpretation of a particular city and country. So 10th of March, by the time this goes out, we'll be launching this and we'll make sure we put links in the descriptions below. But mate, pretty excited. We've had, last year we had expats from 85 countries. And it's just fascinating to just really be a fly on the wall in those countries and just really take the temperature of what's going on. Now we're in a pandemic, there's been a lot of movement by expats. So in some ways, this survey is even more important than ever because those demographics, those circumstances and those conditions may have changed dramatically in particular countries.
Absolutely.
So it's going to be great to see. We've got to run it from the 10th of March to the 10th of May. So give everyone about 3 months to give their feedback. It is completely anonymous. We're not tracking IP addresses. We're not doing any shenanigans, but certainly we're not selling your contact details. If you do sign up to get access to the report once we release it later this year, we're not selling those details at all. To us, you've entrusted us with your responses, and if you do put your contact details to receive a copy of the report, we're not going to breach that confidence at all.
Yeah, absolutely. And I suppose you hit the nail on the head in terms of everything that's happened in the last 14, 15 months. It's going to be a report which is somewhat going to be almost completely different to the previous years. And I say that just because of all the themes that are going to come about, expats moving back to Australia, obviously the transition happening there, whether education is going to be one of the main industries that always come out from those reports as well. The average income of an expat, I think a lot of that data is very interesting, especially when you break it down in countries as well. It just really, I guess, lets you take the local temperature of how expats are doing in those countries. But 85, that's huge.
Yeah, we do get some pretty obtuse countries too, which is quite interesting. So it's always, that's the bit I look for, when you get responses from North Korea, which we always get one a year. And
Same ones. Same guy, maybe.
Yeah, probably same
No.
person. Who knows?
Yeah.
We wouldn't know.
Yep.
It's always interesting to get some really unique responses from unique countries as well too. That's the bit that excites me is, sort of really take the temperature and see what's going on in these far-flung places.
Absolutely. Well, listen, let's kick into it. Listen, I've got some great sort of Q&As that I want to go through today. Mainly a lot of myth busting because it always comes out every couple of weeks. We get a few questions that feed in, and today I want to try and run through as many as we can. I suppose the first one is something which actually comes about quite often. Obviously, expats are overseas, and this question, Brett, which I'll get you to answer, it's a two-part question, and I think a lot of expats that are listening will gel quite well with this. But one of the questions is, should we keep contributing to our Australian investment accounts or find an overseas broker? Question. And then part B of that is what Aussie brokers allow non-residents to even open an account. So a bit of a two-parter. I guess from our point of view, guys, it's hard for us to say, financial products because that's sort of, promoting a financial product and that's sort of breaching that border. But, the original question, should they still contribute to a local Australian broker or should they be doing something offshore?
It's a great question, and I think the response is probably different for a lot of different people. To me, when you live in a place like the Middle East, we do have a lot of considerations, I guess is the nice way of putting it, of living in a place here. Geopolitical risk is one of those, Sharia law risk is another. So generally speaking, you'll want to accrue your wealth outside of the Middle East. If something happens across the waters, with our friends next door, you don't want to be running to the airport while on your phone trying to transfer assets. You want to be able to just run to the airport, off you go. Same with Sharia law. When it comes to the death of a partner or a spouse, it's hard enough to deal with, let alone fighting for you're entitled to in court. So properly structured, properly, thought out, you can anticipate problems that may or may not affect you down the track. But to me, we always say you want to accrue wealth in the country you intend to return to, retire to. If, say, for example, in Australia, they didn't have, you were taxed on shares, managed funds and ETFs like you were with property, then it may make sense to, accrue that wealth in an offshore account. But to me, we always talk about, the big risks of being an expat, sovereignty risk, which is what we covered off on the geopolitical side, currency risk, that's a big one as well too. Murphy's Law always says by the time you want to return to Australia, the currency will not be in your favour. By taking a dollar cost averaging approach over 1, 3, 5, 10 years of you being away, you're getting a smoothing effect on the currency. And when it comes time to leave, it's just time to leave. You're not going, oh my God, the currency's not in my favour or what's going on. Third one, and this is a big one as well too, Australians understand Australia. So when it comes to your protections, that's a big part of it. A lot of the times people don't understand what protection is afforded to them as a customer overseas of an overseas platform. In Australia, we have a highly regulated, probably the highest regulated financial services sector in the world. So you have professional indemnity insurance, you have the Australian Financial Complaints Authority, all these avenues that you can raise an issue if there is, a scenario that doesn't work out too well for you. So to me, it's regulatory risk as well when it comes to being able to safeguard your money.
Yeah, absolutely. And I mean, I'll finish off that last part about Aussie brokers that support non-residents for tax purposes. From a non-residency point of view, you've got to remember that a lot of Australian brokerage platforms actually have their PDS, their product disclosure statement will say, this cannot be seen as being marketed outside of Australia. If you're entering in your current overseas address, a lot of the time that's going to act as a block for you to be able to open that platform. A lot of them aren't set up in a manner that allow non-residents as well. So I suppose commonly we hear that expats, they'll set up in a local Australian address, family, friend member. They'll sign up as an Australian tax resident. But the issue with that is, okay, well, all the shares now that are held in your new portfolio, ETFs, blue chips, whatever it might be, they're not actually withholding the required rate of withholding tax based on the double taxation agreement. So you should actually be paying tax to the ATO when you're not. And it actually creates more of a tax administration burden and drama at the end of the financial year if you're not setting things up correctly initially. So unfortunately, yes, most Aussie brokers, they're not set up for non-residents. People that do get set up, they set them up in the wrong manner. So I guess, it depends. You might be able to find someone that has maybe a limited POA that allows you to set one up, but there are always going to be those issues.
And don't use your mum's address. People think
That's
they're
right.
clever. Oh, I'm just going to put an Australian address, not understanding the ramifications. We've got a gentleman right now we're dealing with. He has to go back and relodge 5 years worth of tax returns because he tried to do the sneaky, tried to set up an account using his mum's address, and the applicable non-resident withholding tax wasn't deducted. And yeah, the rest is history.
Oh, Brett, I've got a better nightmare story than that. I'm gonna fit it out now. So, I've come across a case last year where the non-resident had commenced a portfolio about 12 years ago and was letting their parents look after their tax returns, and they thought they'd been a non-resident. They were a teacher working overseas, and they're lucky enough to hold a large blue chip portfolio, and each year they were lodging their tax returns, they were declaring their dividend income, or their parents were looking over it, and they were getting franking credit refunds for 10 plus years. So all that would need to go back to the ATO. So that was a very worst case scenario, but that's just a reflection of when things aren't set up correctly from the beginning. And obviously, if you're not having the right accountant or individual look after your tax returns either, things are going to go awry. So you can imagine the detriment that's caused. They now have a tax payable, a debt plus general interest charges, and that's being wound down. So make sure things are set up from the get-go correctly. Moving on, we won't dwell on that one too much.
Question number two.
Question number two, how would it work if I own an investment property in Australia but am a tax resident elsewhere? I'm assuming this is probably regarding CGT as well as income tax. How does it all work, Brett?
Essentially in Australia, where it's different, when you live in Australia, your shares, property, any investable asset is treated as a capital gains asset. And when you move overseas, those assets split. So then we have what's called taxable Australian property, house, apartment, mining lease, farm, and then non-taxable Australian property, which is shares, managed funds, ETFs, and LICs. By virtue of the name, taxable means even though you have become a non-resident, you're still accruing a tax liability, both on any capital appreciation while you're away and also too on any positive cash flow that's been calculated. And we're always coming across on a weekly basis people who don't change their mindset when it comes to to managing their assets as an expat. And as I say to folks here in Dubai, you need to take the Akuba off and put the Kandura on. That's the way the tax laws are designed. So, paying down your property debt to be debt-free sounds great. But all you've done is pushed up your positive cash flow, creating a taxable event. You're paying 32.5 cents on the dollar in positive cash flow. And also the other one too, we find, people want to renovate a property while they're an expat, which is actually the worst thing to do. Because as an expat, you don't get the 50% capital gains discount. And if you were to increase the value of that property dramatically while you're a non-resident, then you are going to create quite a large tax liability in the background. You spend 100 grand and the property goes up by another 100 grand. You've virtually just created a $32,500 tax liability, just by doing that. So to me, timing is very important when it comes to managing a property. When you pay down the debt, when you do renovations, you just don't do that as if you were an Australian resident, because it's backwards.
That's right. I mean, you've really got to take stock of what you have. If you have an investment property, long term, okay, what's the right strategy around that, factoring in that you are a non-resident first? As an Australian tax resident, it might make sense, but as a non-resident, it might create a scenario where you're bloating out your capital or your taxable capital gain, as Brett just put it. And then, obviously you're going to wear that when you come back or when you eventually sell it. So be mindful of that. But as Brett said, property, it's taxable Australian property, which means it needs to be taxed by the ATO first before any other overseas taxation authority. Next question, diving into it. I'm living in Vietnam and I have a HEX debt. How does this get handled? I can take care of this one. So obviously we can't escape our HEX debts anymore. They changed the rules around this, where if we're living overseas previously before the 2019 financial year, we didn't have to make a repayment. Now that the legislation has changed, we need to do what's called just a worldwide income lodgement each year if we have a HEX debt. the repayment amount usually kicks in at about, if our annual worldwide income is more than $45,000.
Australian
That's a
dollars
rough
too.
amount. That's
Australian
right,
dollars,
AUD.
yeah.
And the repayment amount is a percentage of your income. It's not a percentage of your debt. So if we're on a really good wicket and we're, I suppose the US or where it might be, the UK, Middle East, it's a percentage of your income. So you can find all of a sudden, crap, I've got a $15,000 to $20,000 tax bill I need to pay, which is just hex. So you can't escape anymore. You must lodge it. So that person that's in Vietnam at the moment, yes, you'll need your hex lodgements, worldwide income to keep winding down your hex bill. What usually happens is you lodge your hex lodgement or repayment, I suppose, return. You get given how much you owe. You then can put yourself on a payment plan. So you pay down 10% first and then pay off the remaining outstanding amount of that year over the coming months leading into the next financial year. So that's how that operates. But yes, we can't escape hex debt anymore. It needs to be paid.
The other point too is the currency, the exchange rate that you use is not that date as of 30 June. It's the average of the that foreign exchange rate for the previous 12 months. And on the ATO website, there's a calculator there.
Yep.
So all depending on how the Vietnamese dong do, try and say that with a few beers under your belt. It may work for or against you, but yeah, just because your currency collapses on the 30th of June doesn't mean you've won, because if it's been strong for the previous 11 months, then there could be quite a hefty bill there.
And the ATO publishes those rates. They're easily accessible, and that's what most accounts have to use. So unfortunately, we can't escape that. Another question. Okay, superannuation. Do I keep contributing from overseas or any other way of not having it eaten up with fees? So they're obviously concerned that because they're not contributing it, they're not receiving any contributions by employer. What do they do with it? Can they contribute to it? Can they not? What are their options, Brett?
Essentially, super's agnostic to residency, excluding SMSFs. So just general super, treated from a tax point of view the same whether you're resident or non-resident. The key consideration I find is there's two considerations. It comes down to personality. I have clients in their 30s who contribute to super because they love that forced savings. I have clients in their 50s who don't want to put money into super because they want liquidity. So that's the first question. Whether you want that forced savings or whether you want that liquidity. The second one is it's a bit of a misnomer when they say I'm not contributing to it. All the fees are going to eat up the balance and it's going to go backwards. That just means you're in a poor performing or very expensive super platform and you should be changing. At the end of the day, the long-term average for super in the last 10 years is 7.5% to 8%. If your balance is going backwards, it means you're paying 7.5% to 8% in fees, which doesn't sound right, but they may be only delivering 3 to 4% in returns, and that's what they're charging you. So you don't need to contribute to super to have a balance, have a portfolio that's growing, have a super account that's growing. You need to review that, compare it on a like-for-like basis of what's available in the market, and look at ICRs, MERs, and all those embedded costs that really they don't have to disclose to you in a very frank and honest way. And then as long as it's performing well, your fees are realistic or modest, then you don't need to contribute. Obviously, little things done early and often give you the greatest results. So if you do like that forced savings mentality, then certainly contributing to super in small amounts. If you've got 20 years before retirement, you may notice a nice little bonus down the end of the track.
That's right. Absolutely. I mean, as Brett said, you definitely can, but it's all going to come back to your initial goals. As Brett put it, the 30-year-olds like the forced savings plan, the older generation like liquidity, having access to it probably as an emergency fund. So not putting into super. It's all going to be goals based. But review your super, check the insurance premiums, the fees, see what it's really costing you behind, I suppose, those fixed fees as well, and factoring in the MERs and ICRs. Next question. Okay, so this one actually comes up a fair bit, and I think it's something that we should obviously put to bed. Are there any issues with transferring money back home? Am I safer transferring back and amounts under $10,000? Is there any entry tax into Australia by transferring it back?
Look, essentially there's a government body called AUSTRAC, AUSTRAC, and they're sort of like the digital gatekeepers of the financial services sector in Australia. Any money coming in or out, they're the ones monitoring that. And what people will need to realise is, you might be trying to avoid being suspicious. In actual fact, it creates suspicion, by you're
Oh,
doing some weird
yeah.
things, and we always say to clients, you're better off hiding in plain sight. Do it honestly, do it up front. If you're transferring $300,000, transfer $300,000. Don't
Yeah.
transfer 3,000, 4,000, 2,000. Think of what a AUSTRAC compliance officer would see, the same amount coming through, same amount coming through, same amount coming through in a very repetitive way. What's he going to say? Is this guy trying to launder money? Is he trying to do this? Is he trying to do that? Whereas if you transfer 200,000 and say house deposit or investment or paying off mortgage or whatever it is, just be open and upfront about it. You want to just breeze past any sort of scrutiny. If the $10,000 rule is the biggest joke, the $10,000 rule doesn't relate to transfers. It's carrying cash into the country via an airport or a port and depositing cash at a bank branch. Apart from that, it doesn't apply. You can be audited for transferring $1,000. If you've transferred $1,000 100 times, that's going to look pretty sus.
Absolutely. And I mean, taking a step further with that additional ad hoc, Australia doesn't really have an entry tax on those sort of cash transfers. I mean, as we say to our own clients, Brett, if you're transferring money back, give it a purpose. Don't leave it just sitting in cash for a very long time, several years, because, it potentially the ATO picks that up and go, does this match someone that's a non-resident or someone that's only overseas temporarily? So it's those sort of questions in the background. But given the whole COVID-19 scenario playing out in the last year, I suppose, that's not uncommon that people are sending money home just in case they have to bounce back as part of an emergency fund.
Essentially, the ATO rely on you to pay tax at the source. So if you work in the UK, US, Hong Kong, Singapore, you pay tax on your income and what you're transferring is your net. So they're relying on that tax being paid. Obviously, if you're in places like the Middle East where there is no tax, then there's obviously no applicable tax. But long story short, when it comes to tax coming in, it's more the actions of that transfer as opposed to the actual transfer itself that can lend you a lot of problems.
Absolutely. And I mean, this next question, it's around portability of overseas pensions. So this lady's just asked, Kiwi savers, can I transfer this into an Australian super account? Kiwi saver and UK pensions, they're pretty much the only ways, the only sort of overseas pension schemes where there is a degree of portability. Usually with the Kiwi saver, we have to actually speak to the local Kiwi super fund or Kiwi saver super fund about the withdrawal process. It's usually processed by an electronic funds transfer, but we need what's called an RBS, a rollover benefit statement, to be able to credit to the Australian superannuation account appropriately. So there's always a bit of a process there. And I'll go into the UK pension portability scheme on the next expat chat, as we need to wind it up there. Just a short one today. Brett, have you got anything further to add for today?
Obviously, we'd appreciate everyone's survey responses. We'll include a link in the description below to that link there. Once again, please keep sending through your questions. We love answering them. That provides us a bit of a gateway as to, what to talk about. It's great for you and I to talk at something, but if people want other questions answered, then we'd rather be audience driven as opposed to us just sort of going off on a tangent and thinking that we know what you want to know. So certainly keep subscribing, keep liking, keep commenting, reviews, really appreciate them. And thank you from the bottom of our hearts, guys, because we love doing this, but it's nice to know there's people on the end of the lens and the headphones who are listening to this and getting a lot out of it.
Absolutely, Brett. And I mean, kicking off for next episode, we're going to be talking about private health insurance and what the lifetime health cover loading means and how you can avoid it. In the meantime, Brett, I'll let you jump off and I'll be speaking to you very soon. Thanks for stopping by, guys.
Cheers. Thanks, guys.
Thanks, guys.